Good afternoon, everyone. Hope you're doing well. Hope you're enjoying your weekend. Now that it's Saturday and the major markets are closed, let's have a look at some of the key charts, some of the trends in major markets, starting, of course, with the US market, the S&P 500. I continue to be of the view that markets are looking very expensive, and for me and my clients, we are preferring to be more so in income funds rather than growth funds, rather than chase growth. Obviously, there's a mix of the two, and there's a balance to be found. But if we, like, these markets are at all-time record highs or very close, we can see on the daily chart, the US market has been in what I believe is this sort of bearish rising wedge pattern. Now, you can see there was an initial breakdown a couple of weeks ago. It recovered, and now it's breaking down again and sort of hovering underneath the potential resistance there. So rising wedge is generally bearish. And if we look at the momentum indicators, the MACD and the RSI, both are negatively diverging. So as the price is making higher highs, the momentum indicators are not. That's when used in conjunction with price action and patterns on the charts. This is generally a sell signal, although I wouldn't use these as sell signals on their own. They need to be used with other things. But this is a pretty bearish sign, and it's a sign that the market is, like, the uptrend is potentially losing momentum. And if we zoom back to a 5-year weekly chart, if we delete those little lines we've drawn, we can see the same thing again. You know, it's in this massive sort of up channel. It's a little bit hard to draw that one, but what I would suggest is that, you know, again, you've got this negative divergence on the momentum indicators as the price is making higher highs, looking very expensive, looking like the trend is probably overdone. There's probably more downside risk than there is upside potential in the short term. Longer term, obviously, I remain in the high inflation camp and quite bullish longer term. If we come across to the NASDAQ, we'll see that. So the tech index, again, let's go to a daily chart, and we'll see, again, a very similar thing, this sort of rising wedge pattern. You might be able to draw it there because you can capture, multiple lows. You've got the low there, but look at that. It looks like it's sort of starting to flatten out like a rising wedge. Again, momentum indicators, they did make a little bit of a high there when the market got to an all-time high, but they look like they're rolling over and flattening out. So again, a sign these markets are very expensive. If we come across to the US dollar, now there was a big pump in the US dollar. Well, really, it started back in September, but again, made a fresh high on Friday night. Candle wick there, indicating that maybe this uptrend, the strong uptrend we've seen in the US dollar is losing momentum. But let's do, from what we did in the last charts, let's do the reverse, and we can see, this falling channel, this sort of falling wedge or broadening wedge pattern. And then you can see along the bottom here, the price was making lower lows as the momentum indicators were positively diverging and making higher lows. So that's the reverse of what we just looked at on those other charts. So price making lower lows, momentum indicators making higher lows, falling wedge or broadening wedge pattern. So these were buy signals. And of course, if you've been looking at some of my videos for a couple of months, we were talking about this back in August, September, massive run in the US dollar. Now, it's a little hard to say because you can see the MACD is still making a higher high. So it's not yet negatively diverging, but the RSI is rolling over. And we've seen this big pump, and we've got that big candle wick there. So it was intraday, it got above 108 on the US dollar index and then sold off quite sharply, I guess, later in the day. So maybe a sign that it's losing a bit of momentum. I think it's probably a little bit overdone here. And if we go to a 5-year chart, you can see, so those are our lines that we drew earlier. You can see once it gets up around this sort of 107 level, that's where it's topped out before. Although looking at that now, you could make a case that it's breaking out. That it's beaten this top from 2023, and then in May 2024, you can see generally down here it's a buy on the US dollar, generally up here it's a sell. So if I look at that chart objectively, and let's just delete those and start fresh. If I look at this chart objectively, you'd have to say the US dollar is breaking out here. So you want to, again, that would be another reason to be cautious on, don't be in that. Me and my clients not chasing growth. If the US dollar is pumping, that's usually a negative for stocks, although the Trump trade seems to be getting a lot of momentum. But this is again a sign that you should be cautious. US dollar going up generally puts downward pressure on most other most other assets, but it's a little bit of a weird dynamic at the moment. So just I'm just exercising caution, but I would say even if this is going to continue higher, it's probably due for a little pullback and then onward and upward, and I'm not necessarily suggesting it'll get back there, but I think this US dollar strength trade is probably a little bit overdone in the short term, and I think over the next couple of weeks we'll probably see the MACD start to roll over as well, and potentially some price action on the chart that would indicate a sell pattern is forming. But it's too early to call it yet. So for the moment, I'll say the trend is extended, but I'm not calling for the US dollar to be a sell or to crash from here. If we come across to the Australian market, again, similar things were on a daily chart. I think the Aussie market was in... I think this was the trend. In fact, I wouldn't even capture that low. I would probably say, is when you're drawing these, I think previous price levels are more significant than angled trend lines. But if you are going to draw angled trend lines, I think you should try and capture as many touches as possible. So for example, if I was to draw the line here, you can see we captured that trend, that it was in this sort of rising wedge, which we learned from the other charts that's generally a bearish pattern or a sell pattern. You can see negative divergence on the momentum indicators as the price was making higher highs. We can really extend that out. So you can see price making higher highs, momentum indicators making lower highs, a sign the uptrend is losing momentum. Rising wedge pattern there, that's a bearish pattern, a sell pattern generally. But what I would do now is see if we leave that line there, we're not capturing these highs there. So let's delete and start again. And what I would suggest is that the line should probably be drawn there, because notice how when I draw the line there, and the Aussie market is probably going to be up on Monday, so it may actually break through that line and we might have to rethink this draw or just adjust it maybe to there. And then if we draw it this way, we can see the touches there, and now it's broken down from the uptrend, touching again, touching again, touching again. It's probably going to trade around here next week, or at least on Monday. Indications the market will be up. But again, we're losing momentum and we're breaking down from a rising wedge, which is generally a bearish sign. So again, not calling for the Aussie market to crash, just suggesting that maybe in the short term it's a little bit overdone, and that's why my clients and I are preferring high income investments, not getting too aggressive chasing growth at these price levels. Gold had a very good week. In fact, it was 1, 2, 3, 4, 5, so 5 green candles, 5 up days for the week. We did see a little bit of a sell-off in gold from the 30th of October to the low. It almost had a 10% drop from high to low. In fact, if you zoom in, you might even be able to find 10% there. But what I would suggest is that in the short term, it was in this sort of falling, broadening wedge pattern. Now, it's a little harder to see on the daily chart, but if I zoom into, say, let's try a 3-hour chart, something a little bit shorter term, we can see maybe a 2-hour chart would be better. Let's have a look at a 2-hour chart, and you can see this trend that I started to draw. So you've got this falling. See, that looks a little bit better because we can match a lot of that up. So let's see if we can zoom in and just look at this a little bit better. So you can see from the 31st of October to the low on the 14th of November, you've got this falling, broadening wedge pattern, and a falling, broadening wedge is typically, once it resolves, is typically a buy signal, a buy pattern. You might even get a little bit creative and say, well, that was a little trend within the trend, like a little falling wedge there, broke out of that. But you can see at the same time, momentum indicators positively diverging. Not quite as prominent on the RSI, but you can see around the lows there, as the price was trending down and making lower lows, the momentum indicators were starting to reverse and make higher lows. So that's positive divergence, generally a buy signal, or at least an indication that the downtrend was losing momentum. And you can see once gold got out of this falling, broadening wedge, if we zoom in, we can see it broke out and a little bit of bouncing along the roof, and then it's continued on higher. So I'm a little bit unsure on gold at the moment, because keep in mind that is the all-time high. I don't like that it made see, that's a lower, so you had a low there and then it made a lower low. little bit uncertain here as to the direction. I obviously had a really good week. In my opinion, fundamentally, gold should be much higher in price. But in the short term, I would again just exercise caution for my clients and I. I normally advocate up to a 20% allocation to precious metals, and that would include gold, silver, maybe a tiny amount of platinum and palladium, maybe some gold mining stocks if you're a little bit more of an aggressive investor. But at the moment, I'm generally advising my clients to be 10%, maybe a little bit more, so less than our 20% full allocation. And that's because if we go back to a 5-year chart, we can see gold has had a great run, really for the last 2 years. If you take the low from October 2022, it's up 66%. Very close to the all-time highs. I don't think you want to have your full allocation as a general rule, if an investment is, or an asset class is at or very close to an all-time high, probably not the best time to have your full allocation to be too aggressive. Silver, the daily chart on silver is a little bit interesting, and this would be an example of, previous levels being respected. You can see that from the low in August, silver was in an uptrend, but here we see these wedge patterns again. Note a broadening wedge, but a rising one. Rising wedge is generally a bearish pattern. Now, we didn't get any indication on, you might say the MACD was kind of negatively diverging, but it was sort of hard to, not a strong signal there. But certainly the price action, that is bearish price action. And we saw, so when it hit that sort of third, the third touch generally, you'd call that the first touch, the second touch, and the third touch is generally, usually these patterns play out with 3 major touches, sometimes 4. I don't have any science to back that up other than just, anecdotal experience of looking at a lot of these charts. That was a 12-year high as well. So it was when something's at a 12-year high, it's probably time to take a bit off the table. And we can see it's had a decent correction. So from high to low on the 23rd of October to the 14th of November, silver went down almost 15%. Now, let's just clean up some of the mess on that chart. And if we have a look at these levels here, you can see that was the previous low. You might argue that it's holding that previous low, but note when I draw this across, again, you can see that it was the previous high in August, low there again. If you wanted to make a bearish case for silver, you could say it's forming a head and shoulders pattern there, although this right shoulder is yet to be resolved. So I wouldn't call that, because you're kind of manufacturing something that isn't really there yet. You could argue that there's support around the $30 level. I mean, that's the $30 level there, that blue line, $30 being a, pretty significant, psychological price barrier. Sorry, let me just check something on my recording there. Yep, all good. So a little bit uncertain on silver at the moment. I guess for an aggressive trader, that $30 level, that previous key level was probably a buy entry. So aggressive traders would have been entering around there. For me, I haven't really, I think I've recommended 1 or 2 clients buy it back, but only because they sold near the absolute high and they were able to buy back at a, 12, 13% discount. And, we bought very small amounts. So a little bit uncertain on silver in the short term. Let's wait for that chart to develop. If you look at US debt markets, in fact, I might save that for when I look at bond yields in a sec. Bitcoin has obviously had a fantastic run. If we're looking at the chart here, other than the fact that it's at an all-time high and it's gone up in a couple of weeks, 47% from high to low, whether you interpret that as a sell signal or not, that's up to you. But you can see there's no real pattern yet on the chart to indicate that it's a sell. We don't really have a rising wedge or head and shoulders or any kind of reversal pattern in the price action. You might say there's a little bit of negative divergence forming on the RSI there. You can see the price made a higher high. Let me just draw that there. The price made a higher high, RSI making a lower high, but the MACD is still going up, and that's a pretty weak signal there. That it's just happening in a sort of like a really small section of the chart. So the only other thing I would say too is that it's nearly $100,000 US. You would think that the $100,000 price level would be a very key psychological price barrier for Bitcoin to try and get through. So I would just say be very cautious. There's no clear sell signal on the chart yet, other than it's had a great run, and $100,000 you would think would be a strong psychological price barrier. We'll see how that plays out. So no clear direction yet for me. I'm staying away from it. It's a bit too risky for me. Oil. Oil's an interesting chart. I don't quite know what's going on here. You could draw this many ways. This is a daily chart. You could argue that the sort of $67, maybe $66.50, this level here, showing strong buying support there. So you can see touch, lots of touches. We are seeing some positive divergence on the momentum indicators as the price is sort of holding this level. So that would generally be a buy signal or a sign that the downtrend is losing momentum. I mean, since the high in April this year, oil fell 23% and it's still down 18% from that high. There's a few other ways you could draw it. You might draw, that gets a little bit messy. If you try and draw it, again, I'm not as much of a fan of the angled trend lines, but you could say that's a trend, that it's still technically, in a downtrend, you've got the price sort of trending lower. So it's grinding. So you could say it's going to break down and break through that line. And I would certainly say that's a valid way to draw the chart. Little bit hard to say what's going on here with oil at the moment. In fact, if we zoom in a bit closer, see, even again, you're not capturing that high. You could argue a case that, if you wanted to make a bullish case, you could say, this was, like a falling, almost a broadening wedge. It's breaking out. Again, when you're looking at this chart, there's not really a clear draw, that's not really definitive. I could draw this 3 or 4 ways. So when you see a chart like that, you just say, okay, well, there's no clear way to draw it. There's no clear direction at the moment, other than to say there's some buying support around 66, 66.50. So we might have to wait and see how that plays out. No clear direction yet. I could see a case being made, for oil being a strong buy below 70, and I can also see a case for it, breaking down from this level, because it does continue to make lower highs. It's grinding lower. So we'll have to see how that plays out. Now, opposite to the US dollar, so keep in mind bond prices, so the price of debt is moving in the opposite direction to the US dollar. So as the US dollar has been going up, as you can see from TLT, which is a long-term US government bond fund, it has been going down in price during that time. Now, I would argue that, it's quite congested here, but you could almost call this, I would call this a falling, broadening wedge. Lots of tight trading activity there, and you can see on the momentum indicator, so as the price was making lower lows there, the momentum indicators have finished going down and are starting to turn positive. So this would be a sign that the downtrend in the price of bonds is losing momentum. Price was making lower lows, MACD, RSI positively diverging. You've got a falling, broadening wedge pattern, which is typically bullish or a buy signal. Momentum indicators are saying the downtrend's losing momentum and it's a buy. And notice how it's holding this level. We didn't see another swing down to the bottom of that channel. So I think prices are most likely bottoming here. And for my clients and I, we've got a higher allocation to bonds, to debt, than we do, say, to growth stocks or to gold or crypto or that sort of thing. So I think, and if we zoom back to a 5-year chart, I mean, have a look at where bond prices are versus where I won't take that spike high, but where they were in 2020, still down 48%, 47% in price. And if you look on a longer term, so that's where we were drawing before on the daily chart. But if you look longer term, you can see, that bottom in 2023, massive positive divergence spread out over a long period of time. It hasn't retested those lows yet. So if it holds here and starts, turning back up, I think over the next few years, we're going to see something like that. So I would say even in the short term, for me, bonds are underpriced. And if we come across quickly to the yields, we'll make these last 2 charts we look at, the 10-year yield. So keep in mind, bond prices move opposite to yields or interest rates. So if the yield or interest rate on a bond is going up, the price of the bond is coming down and vice versa. Just think of a seesaw. Interest rates going up, bond prices going down. interest rates going down, bond prices are going up. So if we look at the 10-year, we'll see the 10-year interest rate, we'll see the opposite. And of course, we see that. So again, I'll show you some of these signals. You can see the price back in July to September was making lower lows as the momentum indicators were positively diverging, making higher lows. Again, same stuff we've looked at on many other charts. And you can see the breakout there. So when this is happening, that means if the interest rate is a buy, that means bonds are a sell as an investment. So that was a time to take some profits. Of course, massive run. Now, what are we seeing on the chart? Well, we're seeing the opposite. We're seeing the momentum indicators start to roll over, negatively diverging as the price was making higher highs. It's a little bit hard to draw a channel there, but if you want to say that's the uptrend, you could say, well, it's starting to break down from that. It was in a nice channel there. Lots of touches on that channel, lots of activity. So the more touching you see of resistance or support lines, the more valid it is. But notice how it's sort of starting to roll over now as the momentum indicators are rolling over. So keep in mind, if this is going down, that means bond prices are going up. So I think bonds, again, further evidence when we look at the interest rate chart that bonds are underpriced. And you can see as it gets up to this level here, lots of activity, lots of previous key price levels. Haven't drawn that line too straight. You can see touch there, lots of trading activity there. It did briefly trade above, earlier in the year. But there is still quite a bit of activity around this area, so it would make sense for this to be, where a top is formed in interest rates and then a buy level is formed for bonds. And let's have a look at the Australian 10-year rate. We'll probably see something very similar. Again, same sort of thing. Back in August, bond prices were making a high. You can see there was a downtrend channel, but momentum indicators moving in the opposite way at that point. Price making lower lows. Momentum indicators making higher lows. So it was a buy, a buy of the interest rate, which means a sell of the bonds. Now, big run, and of course, starting to you can see without being a charting expert, you can see it's starting to top out here. Momentum indicators rolling over, starting to roll over, starting to form a bit of a top here. A little bit uncertain yet. It's not quite a clear pattern yet on the chart, but for me, this is a sign that bonds are underpriced. And if we go back and there was a spike in November last year, but that is, I believe, a high of many years. We're going to a 5-year chart. Let's go to an all-time chart. And you can ignore that many decades ago when interest rates in Australia was 16%. With the debt levels we have, we'll probably never see something like that again. Or I should say highly unlikely that we'll see. But if we go to a weekly chart, this is a monthly chart now. So this is a very longer the time frame, the more likely the success on the chart. That's a topic for another day. But you can see this sort of broadening wedge pattern. So again, if this is topping, that means bond prices are bottoming. You've got this massive broadening wedge. That's a bearish pattern. You can see momentum indicators negatively diverging as the price was making higher highs. They were topping out, rolling over. So this is the charts are telling us that we're most likely putting in a major top in interest rates and a major low in bond prices. And that's why my clients and I continue to have a higher than usual allocation to bonds and a lower than usual allocation to growth investment or aggressive growth investments. We do have some growth investments in some metals, obviously, in commodities, mining, but just a little bit more of a balance towards higher income investments, a little bit just buying areas of the market that are underpriced relative to other areas. Might leave it there. That's a good sort of summary of how markets are going. Congrats to those of you in the crypto markets. You would have had an excellent run. Stocks are doing well, but they're just looking a little bit. It's great that they're going up. We're making some money, but they're just looking a bit expensive, and I don't want to be too aggressive at these levels. So let me just jump back to my recording software, and thank you very much for listening. If you made it this far, I hope you got some value out of the charting analysis. Enjoy the rest of your weekend.